So it's great to actually see people in person. Obviously, this is the this is the first time that we've had the chance to gather in sort of 2 years. Obviously, it is a hybrid meeting because of the current circumstances, but it's nice to have a little bit of normality, even if obviously everyone continues to struggle with the restrictions in place because of the pandemic. So I'm just going to just highlight, I guess, the 10-year numbers, which Andy talked to first of all, because I think obviously everyone's looking to invest for the long term in this investment trust, and that's very much how the board looks at performance and how I look at performance as well. So I think it's also really interesting to sort of dissect that performance a bit in terms of there's been a lot of talk continuing about value versus growth. And very much this is a value trust, as it's always been under Anthony and Sanjeev before me. And that has been a particularly difficult place to invest over the last 10 years, including the 9 years that I've been managing the trust. And that's shown here by the underperformance of the value index that we show in the orange bar, producing only half the performance of the index through that period. And so while performance has been very good for the trust, and indeed we've been able to generate an outperformance of double the market, it hasn't been that market conditions have been conducive to that. We've actually had a pretty difficult set of conditions over my entire tenure in order to produce this performance. And so hopefully this shows that the stock picking, so the big analyst team we've got here at Fidelity and the individual stock performance has been able to override that big headwind in terms of value underperforming over the longer term. I think then if you look at the shorter term, which we're showing in these bars, the quarterly bars here on the chart, it's been quite interesting because there has been a lot of volatility in markets, and indeed through the last fiscal year there have been some periods where value has performed extremely strongly, and so that's one of the reasons why the trust has had such a spectacular year in terms of absolute performance. That actually, as we discovered the vaccine for COVID at the back end of last year, there was that very strong rally which very much continued into Q1 of this calendar year, and you obviously caught all of that in the last fiscal year performance for special values. So while there's been a continuation of that strong stock specific return, particularly in the last year, which is different from actually most of the years that we've managed to trust, there also has been a tailwind to performance in the shorter term, the 1 year period, from value having a bit of a resurgence through the end of last year and the start of this year. This then looks at that performance for the year. So you can sort of see that the share price had its best ever year, up 74%, with the NAV growing 56%, and the market itself having a strong year. So the FTSE was up 27% in the last fiscal year. And I think also positively, as we'll talk about, is the UK market as a whole has been a bit of a laggard. But actually the UK market's performance is largely over this period in line with that you've seen in the US, the world's biggest market. So I think from this starting point, given the valuations and also the fundamentals we've seen coming through in stocks, the UK market is in a much better place now than I think it's been for a number of years, because valuations are still low, but actually there's some quite good fundamentals coming through now, particularly in the more consumer side of the economy, and that's very much been evident in some of the big performers in this last year. So if we just look at some of the companies that have provided the strongest performance in the year, we've picked out sort of 5 the key winners and 5 of the biggest detractors. There's been a combination of a number of different things happening. So first of all, the consumer side of the economy in the UK has been particularly strong. Of all the positions within that space, Halfords has been the best performer, particularly on the bike side. There's been big demand for bikes, but also more latterly, the motoring products have come back more recently as people have got out driving again. And also there's been a shortage of new cars. So again, car maintenance has been a big area of spend as people have been keeping their cars longer. A number of other consumer names have contributed quite positively. So the holding in Kingfisher that we initiated over the last year has also been very positive, as has the investment in Marks and Spencer's, a long-awaited turnaround actually starting to come through there. There's also been significant bid activity in the portfolio. I think that's a symptom of the fact that the market remains really undervalued despite fundamentals coming back, and indeed Meggitt here and then Spire are two of the companies, two of the 10 companies that were bid for in the last year, the bigger positions. We took quite differential approaches to those actually. Meggitt, we think that is an approach that appropriately values the company. It's a US-based acquirer that was trading on a very high multiple, paying a pretty high price for Meggitt. And so we're happy for that deal to go through. On the flip side, Spire, we thought that deal, even though it was at a premium to where the shares were trading, was not fair value for the company. And we were very vocal externally about the fact that we were going to vote down that deal. Thankfully, one of the other large shareholders also backed us on that. So our combined votes meant that deal has not gone through. We're still very excited about the prospects for Spire, and that's very much still in the portfolio today. Mighty has had a very good COVID crisis, very different from how people thought the company would react. And indeed, it's allowed them to do a very well-priced acquisition of the Interserve business that we backed in the fourth quarter of last year with a large rights issue. It's unusual that our companies raise significant equity because we're obviously normally investing in undervalued equities. And when you're undervalued, the last thing you want to do is issue equity. The great news was that while Mighty was very undervalued, the target they were buying was even more undervalued. A company that had gone through bankruptcy was now largely owned by the banks and debt holders, and they simply wanted to get shot of that company. And so Mighty was able to buy that business at about 2 times cash flow. So an unbelievably well-priced deal, which has been very positive for the company. And then within banks, AIB may have shown up actually, as we talked last year, as one of the big detractors from performance. But it's the bank that we bought the most of back in April 2020. We had one of the strongest balance sheets of any bank in Europe. And then there's been a big change in the competitive position in the Irish banking market. So finally, after 10 years of limping along, the number 4 and number 5 players in the US and the Irish banking market have stepped out. So actually we've gone from a 5-bank system to a 3-bank system, and AIB have actually picked up some of those assets as Ulster and KBC have exited. So again, exactly the kind of thing we look for, a stock that's been hit because of the overall sector issues and the COVID issues, but actually where something really positive has happened underlying. Weak performers are quite interesting this year because actually most of these stocks haven't actually fallen in value. Largely, these companies are all pretty much the same price as they were 12 months ago, and they're all defensive businesses. So it's mainly that actually markets have been so strong that these more defensive positions have underperformed just by not rising in line with the market, which was up 27%. I particularly pick out Serco as one that is surprising that it's been such a big underperformer, because Serco have really stepped up to the plate and run a number of government contracts that are brand new through COVID and have been very helpful in delivering testing and running the test and trace system, which has been profitable at the margin, but also have offset some of the non-COVID work, which has gone backwards. For example, the leisure sector, where they run leisure centres which have been closed, and some of the train services that they run. So that company has seen quite large earnings upgrades, including doing acquisitions through this period in the US. The Australian business has also worked really well, but yet the stock hasn't reflected that. So I think even in these more defensive sectors, there still remains quite a lot of value because these companies have generally unscathed or actually have done fine from the COVID recession and the COVID restrictions, but yet their valuations still remain quite low. If we then just track how the gearing of the trust has moved, you can see here the last 7 years that the gearing's moved quite dynamically through this period, from as much as 5% cash in sort of the middle of 17, and then again back into net cash in the middle of 19, when we were seeing sort of less opportunity, to a maximum gearing of just over 20%, which was actually around this time last year, as we went into Q4 2020, when we saw the most opportunity in markets. You can see that's now started to moderate. And indeed, if you take out the takeover bids that we still own in the trust, we're about 7 or 8% gearing today. So slightly below what we would say the neutral level of 10% is. And that reflects the fact that we've had some big winners, we've had those takeovers, and markets themselves have done well. So we're slightly below neutral levels. I think there's still quite a lot of opportunity in the markets in terms of valuations, but there certainly are more uncertainties today than there's been over the last 6 months, particularly on the inflation front, and then obviously with the virus itself, the new Omicron variant, obviously prolonging the restrictions and issue around the virus itself. So the trust is taking a slightly more defensive stance, waiting to invest that money that we've got from the takeovers rather than immediately investing it. This then looks about where we're positioned, and that the big change here, you can sort of see over time, is very much in the GDP sensitive sectors. So this was something that coming into the COVID recession, we were quite underweight cyclical companies, because most of those companies, if they were particularly ex-UK earners, as 75% of the UK index indeed it earns its money ex-UK, had done generally well over time, and so there was less value in that part of the market. Those stocks generally fell most heavily in early 2020, and we particularly saw all those opportunities in more cyclical companies, particularly UK cyclicals and consumer-facing companies, and we built up that position. More recently, we've moved back a bit more towards neutral in pretty much all those sectors. So again, reflecting the slightly more uncertain environment and some of the big winners we've seen in that space, particularly in the housing area, likes of Grafton, LSL, in DIY, builders merchants, estate agency doing extremely well through the crisis, and we've sold down or sold out of those positions. We've largely maintained the financial weight through this period. This has been particularly in life insurers, which we still really like. Legal in general and Aviva have been decent contributors to performance in the last year. And then at margin, we've also added back to some of the banking positions. So we're about equal weight, the banking sector, about 8% of the fund there compared to the 12% in life insurance. So still very positive on life insurance, and more neutral on banks now, particularly liking the UK domestic and Irish domestic banks, not owning HSBC, which is obviously a global investment and business bank. These are some of the key transactions in the fund. So the biggest sale is CLS. This is a very long-standing position, so something we bought right back at the start in 2012. It's a commercial real estate company specializing in offices. It's a company that was a very good contributor to performance over time. So we sold it about 70% higher than we bought it, and also collected dividends along the way. And indeed, I don't think anything is going wrong at the company. The issue is what's happening in the sector. So I think one of the key structural changes with COVID is going to be increased working from home, even as people are coming back to offices before Omicron. Office occupancy, particularly in London, has been very low. Hybrid working is very much the new norm, and that creates a much lower demand environment structurally going forward than you've had historically. That hasn't really affected values yet, because increasingly people don't really know how the new world's going to look. They're watching and waiting. They're largely still occupying the same space, but with much lower occupancy. But that isn't going to persist forever. Ultimately, of the 350 companies we probably talked to in the last 24 months, every single company to a man has said they want less office space going forward than they had before. The question is just they don't know how much less. So that, which was a 2% position, long-standing position, has been sold out. The other three were largely around performance. So Sylvania Platinum is one of our mining positions. Platinum is obviously an industry that has a finite life, because it's primarily used in auto cats. And so while demand is still growing today, over the medium term, demand is going to fall. And that created a really interesting situation where effectively there's very little investment in new platinum mines, but still strong demand. And so the platinum price was extremely strong. And this is a low cost producer because it basically reprocesses existing dumps rather than actually mining. So quite good risk reward in terms of that very low production cost, very low share price, but potential on the upside. And indeed, that stock was up over more than 800% during its time in the fund. Was a very small position, a very small company initial purchase, but a good contributor to performance that we had been trimming for a long time and finally sold out of in the last year. ArcelorMittal also a somewhat similar story actually in terms of no one's building a new steel plant, but steel demand very much came back post-COVID. The stock had an incredibly strong run and we sold out after performance. And then CRH, also a very long-standing position, beneficiary of infrastructure spend in the US. As finally that got priced in, we sold out of that stock. In terms of new additions on the right-hand side, you can sort of see M&S and Ten Entertainment were new additions in this fiscal year in the more UK consumer-facing space. M&S is very much around a deep turnaround in the business they've been trying to turn around for probably more than 20 years. So huge skepticism that could actually be done. I think actually COVID has been a real spur to getting the business finally properly turning around, and also the current management team, which is led by Archie Norman as chairman. I think actually it's the first time they've had a really deep, credible management team that can act that. And we've already seen strong performance. Secure Trust was adding into the banks. Ten Entertainment is a bowling operator. So again, very badly hit through COVID, but actually a space that particularly as cinemas increasingly closed space, because again, people have got used to watching films at home. Particularly Disney owning a streaming platform means that the cinema window has been restricted because it's in their interest to do so. Means that I think leisure operators that are an alternative to cinemas should actually benefit. So you've already seen that actually on reopening that bowling has been extremely popular, very high like-for-likes compared to 2019, up over 20, if not 30% pre the most recent restrictions. So that started to play out. And then I think Shell is worth talking about. It is a stock that we had previously sold when they cut the dividend along with BP. But I think Shell very pragmatically actually has really thought that was a mistake. They've increased the dividend level again, and they've also started quite an aggressive buying back of their stock. So the capital allocation I had a big problem with in 2020 looks to be on an improving path, quite differential to BP, because BP is very much doing a lot more investment in renewables in very capital intensive way. So they're becoming a very large wind farm developer. And I think the returns from that for BP are going to be very, very low. Whereas Shell is looking to invest in the energy transition, which is necessary. But they're doing it in a much more capital light way through trading, using their gas business, their LNG business, procuring electricity and supplying it to customers in the UK with their first utility business. Also, that's picked up a lot of customers recently as competitors have gone bankrupt because they're not backed by strong companies, nor do they have the hedging in place that the big companies like Shell and British Gas have in place. And so actually the fundamentals of that energy supply business, which is Shell's spearhead into the energy transition, have actually improved. I think it's also worth talking about sort of some of the challenges that are now happening in the sort of what was looking like a post sort of COVID world. I think what's interesting is that the very strong consumer spending that you've seen coming out of COVID and the still supply constraints because of production bottlenecks has started to produce quite high levels of inflation. And it's probably this that's made me more cautious rather than actually the new variant over the last 6 months, because I think if this gets entrenched, which it has every possibility of doing, this is probably negative for asset markets globally. And a number of markets are at very high valuations globally. And so we've done a lot of checking through the portfolio about the pricing power of companies, how easily can they pass on price increases, And indeed, what's unusual is that the environment, because the consumers got so much money and they've been restricted from spending, generally you're able to pass through these price increases to consumers if you're in more discretionary areas that people want to spend. So cars, durable goods, people are able to put up prices. A bit less so maybe in sort of food and HPC. So obviously you can see Unilever's had a number of profit warnings this year because they haven't been able to pass on the big cost increases. So I think we've been relatively well placed so far, but this is certainly something that we're monitoring. What's interesting is the thing that keeps me really positive, despite there being obviously a lot of headwinds globally, is just how relatively well placed the UK market is. So this is about valuations, which is clearly at the real heart of my investment process. So the UK has been cheap for a long time. So you can see here the sort of UK market starting to derate post the referendum vote in 2016, very clearly versus both the US and the Eurozone, so that we used to trade in line with the Eurozone and now we're 22% cheaper. We used to trade at about 20% discount to the US because of sectoral differences between the indexes, but we're now about a 43% discount. And you can see basically no closing of that discount over the last 12 months, despite the better fundamental performance in the UK and the strong earnings growth that's come through. So that's pretty unusual. Like the UK has been cheap for a long time, but fundamentals pre-COVID were questionable. Consumers were holding back, businesses were holding back investment. There was a lot of political uncertainty around Brexit and elections. And there was kind of reasons that people should stay away. I think post the Brexit deal, which was agreed, it's obviously not a perfect deal, but we have a deal. We don't have that cliff edge anymore. And the strong fundamentals coming through from the UK economy, particularly domestically and on the consumer side, it's really strange that these valuation discounts are persisting. So the UK continuing to trade right at the bottom of that 10-year valuation range on 12 times earnings, compared to most markets well outside of their 10-year valuation ranges, particularly the US on circa 22 times earnings. So I think there are dangers in absolute terms from asset markets today. Prices are high, but those dangers are primarily outside of the UK. So I think on a relative point of view, the UK looks particularly well placed. I think value equities and a value market is one of the few places today where you can actually protect your capital, because you can't really do that in bond markets. I don't think you can do that on global equity markets as a whole, because these valuation levels, I think, do produce a lot of risk for investors. So one way these undervaluations are being noticed is by acquirers. So I think it's absolutely no surprise that now that fundamentals are good and valuations have stayed low, that is really attracting interest from investors. Now, strangely, it isn't changing the overall valuation of the UK market, but US corporates and particularly US private equity companies, where there's been a huge amount of money raised, are very interested in UK assets. So we've seen particularly unprecedented year of bids. I think there's 11 companies listed here in a portfolio of only 110 names. That's a very high percentage of companies to be bid for in just over a 12-month period. And also some of the premiums that these companies are offering are really high. So typically you'd see maybe between a 20 and 40% premium. If you look at the Meggitt and U&I deals, some of the most recent, those are both at a 70% premium to the undisturbed share price. So again, really showing the level of misvaluation in UK equities compared to other markets, particularly the US market, but also private markets where a lot of money has been raised. And so I think unless you see the UK significantly outperforming, this is going to be something which will continue to be the case, more takeover bids of UK companies going forwards, because these investors, which are well-funded long-term holders in terms of corporates or more short-term holders such as private equity, really see the value. And I think investors as a whole really need to start investing to actually move the whole market to prevent this happening. If we then just have a look at the characteristics of the fund, this sort of shows why I'm excited about it's not just the valuations, it's also the fundamentals. So price to earnings of the market, quite low compared to other markets. So the UK market on 13, the trust, if you aggregate up all the stocks, on about 11 times earnings. And we're getting there not by buying bad companies, because in fact, if you look at our return on capital, it's roughly in line with the market at 10 to 12%. It's not by taking more risk, because the debt to EBITDA is below that of the market. And indeed, it's not by buying slower growth companies, because if you look at the sales growth of the fund after the big 2021 improvement post-COVID, we've still got decent sales growth, 5.8, then 3.5%, and also very good operating profit growth, so 16% and 9.5% for the fund. And that compares to the market, actually, where after the large increases we've seen in 21, there isn't actually much sales. And indeed, we're seeing operating profit growth go backwards. And the key reason for that is because of the weight of the oil and gas, and particularly the materials sectors in the UK market. So materials is about 14% of the index, and oil and gas is about 9%. And there our team is expecting a fallback in both the oil price, but particularly a fallback in the iron ore price. So it's mainly those large miners, Rio, BHP, Anglo, that are seeing earnings down between 25 and 50% that are affecting the overall market levels there. And indeed, that's an area which is a key underweight in the fund. Those stocks do look cheap on PE today, but it's on falling earnings. What we want to see is stocks that look reasonable value on today's earnings, or cheap on today's earnings, but actually have an improving profile, hence the improvements in sales growth and operating profit growth we're seeing for the portfolio, in contrast to the market, which is seeing a stagnating basis overall because of the large weight of those sectors. So I think it's worth saying that overall, the backdrop for the UK equity market is more conductive because we've had that Brexit deal, and the UK has been on the front foot on the vaccination programme, and particularly on the booster programme. We're well ahead of other markets. So actually, I think both on the political front and then on the COVID front, UK is relatively well placed compared to the world. But despite that, the market remains extremely cheap. So that's why we're seeing all this acquisition activity. And I think this is very much going to continue unless the market significantly outperforms. I think it's fair to say that there are quite a lot of macroeconomic, political, and virus risks still out there. And clearly, I think for asset markets globally as a whole that have done very well, that is a risk. But when you're starting at such low valuations, and also you're relatively well placed, I think the UK is a very good place to counteract those risks. And so I do still see good value both on an absolute and a relative position. And I think that the fundamentals of the portfolio also continue to look good. So that's it for the presentation. I'm not sure if we're going to take Q&A now or if we're going to do that later.
Well, Alex, can I thank you for your presentation, as always, most interesting and informative. Now, ladies and gentlemen, if you would like to ask a question, could I please ask you to raise your hand and wait for one of our attendants to bring you a microphone. For those investors who have joined us virtually, please click on the Q&A speech bubble icon and type your questions into the text box. Alex Denny will pose your questions to us. Now, firstly, are there any questions from the floor for Alex? Yes, sir.
Morning, Alex. I have a couple of questions, if I may. I notice in the portfolio you have WPP. I'm wondering why not S4 Capital, where Martin Sorrell now is. Also on life assurance, I was a founding member of St. James's Place when it started, and I'm interested to know why you're so positive on that area at the moment. And in fact, I've seen their share price kind of double in the last 16 months. And finally, how do you manage such a large portfolio, 130 companies? I know you have a big backup, but the size of it surprises me.
Yeah, so I think the answer to the first two questions is actually quite linked. So if you look at the valuation of both S4 and St James's Place, I would say those are both growth companies. So those are companies that are particularly S4 Capital. So S4 is growing very quickly, is doing a lot of acquisitions and is valued extremely highly. So 30, 40 times earnings. So very much not the kind of company that I would look to invest in because it's very richly valued. And also the fundamental story relies on them continuing to be richly valued so they can issue paper to do acquisitions. So I'd say, while that can work, it's a very, very dangerous investment thesis because if the company comes off, it means actually the fundamental story also comes off. So the share price really affects the future value of the company. We want companies that if they come down in price, we actually want to buy more because they're actually better. You've still got the strong fundamentals behind them. If the fundamentals depend on the share price, it's quite a risky investment. WPP, in contrast, is a company when we bought it trading on about 9 times earnings, and those earnings were depressed by COVID and also margins that had come off. Because indeed, particularly over the later years, WPP did not integrate the acquisitions that they made. It was very much run as a series of fiefdoms. It was run how it was 20 years before, which I think was a successful model, but things have moved on, and a lot of their competitors that were big, the Omnicroms, the Publicis, had done a much better job of integrating their businesses. So again, I think that while Martin Sorrell did an amazing job to found a multi-billion-pound company, grow it to a huge size, things didn't really move on. And so actually the new management there, professional management, outside management, I think is really moving them into the sort of the more grown-up model that is unusual for a company their size to actually still really be run as a small company when you're a global behemoth. So I think the degree of change there and the effectiveness that integrating those acquisitions, working as one team could bring, could be really interesting. And indeed, you started to see that come through. They've won some really big contracts from competitors recently on the basis of that integrated offer. So that there's not just an improvement from bouncing back from COVID in what is a very strong environment now for media, but also them starting to take market share for the first time in probably 7 or 8 years. So that's why we really like WPP. And then life insurers, St James's Place isn't really a life insurer, it's an asset gatherer. So I would compare that to a wealth manager like a Brooks Macdonald or a Brewin Dolphin. While they have life insurance accounting, they're not a life insurance business. The reason I like the life insurance companies is about the bulk annuities and the fact that pension schemes continue to want to de-risk, and that is a very highly regulated and difficult space to enter. So there's very strong demand and actually not particularly price sensitive buyers, because what people want is they don't want the best price, they want the best overall holistic proposition for their members. So it's the trustee and the firm which are making the decision to do a bulk annuity buy-in. The firm wants to de-risk, that the firms want to run their business, they don't want to run pension schemes. The trustees don't really want the pension scheme to be attached to the company because they just want the most safe, most highly regulated offer. And they also want a specialist. They don't want a company that does something else being the person that runs the scheme. So it's a really unusual market that has very attractive characteristics, and yet the companies trade as if they're banks on sort of 8 to 9 times earnings with 6 to 8% dividend yield. So that's why I really like that space, because the bulk annuity market is so attractive.
Just a general question. How well protected is the fund from a sharp uptick in inflation, which seemed very likely, perhaps a bit less likely than was?
So inflation has already upticked quite substantially, particularly in the UK and US. So UK inflation levels are running sort of 4 to 5%, and US a bit above that, more like 5 to 6%. And so those are the highest levels we've seen for a decade. So inflation is already something which is occurring in the major economies that the fund is exposed to. I think the good news is that a value strategy is particularly well placed on a relative basis, because the market, I think, while it sees these effects, and these are affecting companies, and we're seeing lots of price rises today, it hasn't yet got to the point where it says this inflation is endemic and this is actually boosting long-term bond yields. If long-term bond yields do rise, that's obviously very negative for people holding bonds, but also it's very negative for people owning growth equities, because those are the discount rates that these companies are priced off. So generally, inflation going up and bond yields going up is negative for asset markets globally. That is most bad when you're at the highest valuation. So if we just look where the highest valuations are, they're in the US, and that is the biggest part of the global stock market. So I think higher inflation, if it sticks, is bad for asset markets full stop. But on a relative basis, value equities and the UK market are much better placed.
Just a comment also on life insurers, which are your two biggest holdings, and I hold Legal and General as well. There's a factor, I think, in these which isn't mentioned in your little commentary, which is about demographic change. I mean, the reason why companies are trying to de-risk their pensions is because of their unknown nature of their long-term liabilities. And so they shift that onto people like Legal and General. And actually, the best thing that can then happen is that the policyholders die off. Because although there may be some immediate payouts, you de-risk the long term, and that releases provisions. And all of that goes straight back, in effect, in the end, to the shareholders. So, and this is actually what's been happening over the last few years. The demographic change in the population is to shorter length of life. And that, I think, in the aggregate, is an extremely powerful reason why life insurers are an excellent bet.
So that is true. In the last couple of years, it's interesting. So thankfully, actually, people aren't dying more quickly. They're just not living longer than people were expecting. So effectively, people are still continuing to live longer, but there isn't well, in the US that isn't the case, but in the UK that's still the case. So people are still generally living longer, but not at the pace of increase in life expectancy as you've seen over the previous years, which is how the models and pricing was calibrated. So you're right, there has been a mortality benefit to all the life insurance sector over the last 3 to 4 years. And that isn't due to COVID. This was happening before COVID. And it's primarily around, particularly because people are richer lifestyles. So healthcare has continued to improve in importance, but people in general, so diseases that limit life like heart attacks, diabetes, etc., have been rising because the population as a whole is becoming less healthy for lifestyle reasons rather than actually medical care not continuing to improve as it is. Obviously, unfortunately, through COVID, that has created a short-term mortality spike as well. But that is, none of the life insurers have taken a benefit for that because, one, the pandemic is not over, and the expectation is hopefully that is a short-dated mortality spike that isn't going to reoccur in future years, whereas the number of years that the sort of curve has been flattening on life expectancy is long enough for that to be a trend where they have taken some profits. Generally, however, I would put a PE of 1 on those sort of profits, so that the market isn't paying up for those big one-off profits, because whether those will continue to reoccur in future is very difficult to know. Clearly, because we haven't taken any benefit from COVID yet, they will definitely reoccur over the next 3 to 4 years as that does feed in. But whether that continues beyond that period, I think, is an unknown. So we focus on the fundamentals that we do understand, the demand supply dynamics of the market, the pricing of the market, rather than some of these big assumptions that I think are difficult to predict beyond the short term.
Do you have any further questions from the floor? Yes, madam?
Very small one. Alex, what's your view of Shell's decision to merge its 2 lines of shares?
Yeah, so I think that's quite a positive decision, and it's something that we voted for, because the primary benefit of that is it removes what was a restriction on how quickly Shell was able to do its buyback program. Because of the withholding tax issue in the Netherlands, it meant that they couldn't buy back one of the 2 lines of shares. and therefore in terms of the speed that they could actually return capital via a buyback was really quite slow. And so there was every possibility that, in fact, with their big sale of the Permian assets at a very good price, there was a potential they might have to return that as a dividend over a buyback. And I think when you're undervalued, as I think Shell is, that's why it's in the portfolio, it's much better to do a buyback than it is a special dividend. Clearly, if you're overvalued, it's better to do a dividend than a buyback. And so the fact that it reduces the complexity allows them to do that for this deal is the key benefits. There's also some streamlining effects as well, in terms of, I think there's a bit of a cost saving going forward, that they don't have to maintain this strange structure. It also removes a risk that the current, what they call dividend access mechanism, there could have been a change of law in Holland, which meant they might have had to have paid more tax on that over time. So that risk is removed. And it also allows them to do potentially more disposals much more easily. You don't have to get permission from the Dutch government anymore to do that, because it would have affected that dividend access. So I think overall, it's not a transformational move, but it's certainly quite a helpful move at the margin to enhance the Shell story.
Any other questions from the floor? No, could I ask Alex Denny, have you received any questions?
Just a couple, Andy, if I may. So the first one is from a Brian Moretta. We look like we're about to enter a tightening cycle for central banks, ex the pandemic and inflation. How do you see this affecting the portfolio?
Yeah, so I think there is a possibility that we're entering a tightening cycle, although I think that's definitely, certainly in terms of the UK market, been put off by the Omicron mutation. So I think otherwise we would have seen the Bank of England raise rates this week. I think that's very unlikely now, although the market is still expecting that to happen in the first quarter of next year. Now, generally, as we sort of talked before, the reason rates are going up is because inflation's going up. Normally, as rates rise, long-term bond yields go up, and that is negative for asset markets. So it's negative for bond markets, but it's also negative for the valuations of markets overall. I think on the flip side, though, there are companies that will benefit from that. So particularly the banks make more money when interest rates rise because they make bigger margins. So particularly retail banks that have a lot of deposits where you generally pay zero, you don't pass through a rate rise, certainly from these low levels of interest rates. So a really striking example is NatWest, which is the second biggest of the bank positions behind AIB. A rise from 0.1%, the current level, to 1%, which is actually the market consensus for late 22 or early 23, would boost profits by about 25%. So they're actually quite transformational for the profitability of the business. And the rating of that bank is about 8 or 9 times those profits. So I think there's going to be very little multiple contraction from higher discount rates when you're already at such a low valuation, and the earnings will be higher. In contrast, most companies will see a very slight increase in their interest costs on their borrowings, and the chance that their multiple contracts is that much higher because markets globally can see G7 markets are trading close to 20 times earnings. So I think higher interest rates because of higher inflation are a risk to equity markets as a whole, but on a relative basis, the trust is very well positioned. And even on an absolute basis, the earnings of the fund actually will probably have a slight positive benefit because of how the fund is positioned in financials compared to industrials.
Thanks, Alex. And then we had one by email as well, which is there a catalyst needed for the UK revaluing, given it's been getting cheaper since Brexit, or will it just happen naturally?
I think it's that's the thing that I've really been scratching my head at over the last 12 months, because I think it's obvious. You can sort of see here what started the derating of the UK market. So the UK market is a small percentage of the global market. Brexit is something that is sort of without precedent, particularly you think about it, if you're an investor sitting in the US, how do you analyze what this is going to mean for the market? It's a big imponderable, and the UK's 4% of your global benchmark. So it's a good reason to just not bother looking. And so increasingly people have just been divesting or not reinvesting in the UK market during this period. I think then obviously at the start of COVID, you as I probably said last year, you could see that the UK was a bit shambolic and a bit late in our response. And so the UK market was particularly badly hit by that, and the fact that the economy is particularly exposed to consumer and face-to-face sectors. So we had a very bad initial COVID effect. So you could sort of see why people were staying away. Those two imponderables. The UK has done badly on COVID. We don't know what's going on. Don't know what's going on with Brexit. Fast forward 12 months, both of those, while they're not finally settled, the range of outcomes is so much lower. So we've had the Brexit deal. There's clearly lots of disagreements about Northern Ireland, but Northern Ireland is a very small GDP and indeed small population part of the UK. So overall, people know the outcome. It's not perfect, but they don't have that big cliff edge. They don't have that big uncertainty of how the relationship will look. We largely still do have a free trade agreement in goods. And so that has been sorted. And then obviously the COVID response, particularly on the vaccine, has been very rapid and has been close to world leading. So actually, in terms of the UK reopening and coming out of COVID, it's actually very much ahead of the rest of the world. But yet the valuations haven't changed. So you can see here actually a continued derating of the market over the last 12 months. And the big difference now is that derating isn't because also the earnings are worse. The earnings have been as good or better than other markets in that recovery. And so it's a particularly strange period that this is now happening. Fundamentals are better and valuations are still low. And that's why you've got all these takeover bids. So it's not that people haven't noticed. Very clever people in private equity and US corporates really have noticed, but investors as a whole are not yet piling in. And I think that's what needs to happen. The UK market as a whole needs to re-rate to stop this degree of takeover activity. Otherwise, you're going to see the UK market continue to shrink because very highly priced businesses are going to take out the very lowly priced UK ones.
Alex, any further questions? Any final questions from the floor? Well, on that basis, Alex, can I thank you on behalf of everyone, not only for taking questions, but also for looking after our money so well. Thank you very much.